They trade one or two commodities. They caught the gold move. They caught the oil move. They made their millions and millions and millions of dollars trading one or two instruments, and that's it.
Welcome back to another episode of the W.O.L.F podcast, the world of learning finance, of course. I'm your host, Gav Blaxberg, aka W.O.L.F Financial from the world of Twitter. And today I am joined by someone who I've really come to love having on my Twitter spaces. And that is going to be Mish, also known as Michelle Schneider. She is a managing director. She's a partner of 3 different companies, a fintech author with a great book, and a registered investment advisor, among many other things, and an accomplished career. Mish, it is great to have you on today. I would love to just give you the opportunity right off the bat to tell us a little bit about who you are and how did you get started in the finance industry?
First of all, thank you so much for having me on here with you today. It's such a pleasure to meet you and see your face because, as you know, the world of Twitter is often just an avatar, whatever they choose, and some kind of a name. So it's very cool. Okay, so the quick story, because obviously I've been in this business a long time, is that this was, if you believe in fate, Bechet, then you know that sometimes things just happen in your life. And if you are open to following paths of least resistance and to the signs from the universe, or however you want to view it, that's essentially what happened to me. So I was a special ed teacher. I was living in Queens, New York, where I got married for the first time. I did everything my parents told me to do. I lived near them. I got married young. I became a teacher. I grew up in a very modest economic family in terms of income. My dad was a mailman. My mom was a housewife. So there was no talk around the dinner table of finance, stocks, or anything like that. And I was also, I worked my way through school. And so it wasn't like I went anywhere, like to Wharton or anything. I went on a partial scholarship to state universities. And then I went to CW Post for my master's degree in special ed. And that's kind of where I was at. And then one by one, it was like, let's pick off the things that don't necessarily work for me. So I left the first husband, and I always say that's not to be unkind, but I was a kid. I got married because I met him on the basketball court because I played basketball when I was in high school and college. And then I moved to Manhattan, and I was still teaching. And then one day there was just this magical knock on my door of a girl that lived upstairs from me. And I opened the door, and we became instant friends. And she worked for Merrill Lynch on the Commodities Exchange in New York in the World Trade Center. And after we became friends for a while, and she said, "Oh, you want to come down to the floor and see where I work?" And I'm like, absolutely. So when I got down there, my head exploded. I mean, it was like, wow, this is where I need to be. I'd been very good in math in school, so I had a head for numbers, as they say. But yeah, it was just, I saw the action. I didn't know what commodities were. I didn't get a job right away. It took me a while. I kind of went through some channels. Finally got a job working for Conti Commodities, which was part of Continental Grain, as an analyst on the floor, and off I went.
Wow. So commodities, let's talk about that for a second. Were you drawn to commodities, or was it kind of the easiest access to the industry? But then once you were in it, what is that like? How different is the world of commodities from the rest of traditional finance?
Well, when I got into the commodities market, it was the height of the commodities market. In fact, equities were dead, which is something that I talk about a lot because we had gone through inflation and then stagflation in the late 70s into the early 80s. And that is exactly when I got started. So thinking about stocks was not even on my radar. I got down to the floor and gold was going crazy, silver, sugar. Then I got into crude oil and that went crazy, and orange juice everything was going crazy. So it wasn't like I thought, oh, gee, I should be a stock trader. I hadn't even seen the New York Stock Exchange yet. So there was definitely a divide between the commodities traders and the stock traders. Of course, I came to learn later on that all the commodities guys had stock portfolios as well, which I eventually had myself. But yeah, I mean, there was nothing to think about. It was a no-brainer. It was amazing. Commodities, the reason why I still love them and kind of glad that in the last couple of years they've come back into vogue is because they're raw materials. So it's not like buying a stock in a company. You're actually buying a future. Now you can do it through an ETF, but you're buying a future based on the speculation on whether or not you think that particular commodity, whether it be mined or grown or cows or, back then pork bellies, you thought that they were either going up or down based on really basically technical analysis because we didn't have the information we have now, but also some fundamentals as well. So it was fun. It was a lot of fun.
Yeah, I've only tried trading commodities via futures once. I think I ended up trading some lean hog futures. It was interesting though.
Yeah. Well, you kind of tend to remember your first commodities trade, right? Because it's so different than buying a stock. But the procedure really is kind of the same as far as there's support, there's resistance, there's moving averages, there's phases, there's breakouts and flags and all the same stuff. It just moves a lot faster sometimes than what a stock would, although these days not so much.
After a decade in the commodities industry, you really translated those skills into a bunch of other areas, a bunch of other firms. So talk to me about how it was a launching pad and what you did after that.
Well, to go back a little bit, so in 1982, Conti Commodities went belly up because they were backing all the trades for the Hunt brothers that tried to corner the silver market, and that didn't work out so well, so they had to declare bankruptcy. Part of the Hunt family did. Not the sister did okay, interestingly enough, it was the brothers. And Conti Commodities went out of business. So now I'm on the floor. I had a seat in the commodities exchange on the coffee, sugar, cocoa exchange, and now I'm completely unemployed. So I had, again, fate, sort of like, what do I do now? I took a quick job working for another firm, but at that point now I knew too much, and I wanted to just trade for myself. So I became a local, is what they called it, down on the floor, one who trades for themselves. And I went over to COMEX, which is the silver and the gold market. And then I went over to NYMEX, which is the crude oil market, where I spent the bulk of my time. Then I went over to FINEX. And at this point now, it was because the S&P futures and interest rates were starting to be more of a factor, right? Volcker had come in and goosed up the rates. And so I started trading more financial instruments, and then I left the floor completely and went upstairs, as they say. And that's when I really started trading more stocks.
Okay, awesome. So you get to the stock trading part of the world, and obviously you've been very successful there. How would you describe your trading technique and style?
Well, I have to also say that in the course of all of that, in 1987, I started dating my now husband, Keith Schneider, who was also a commodities trader. And he was leaving the floor. He actually left the floor in about 86, 87. And so he was already much more experienced in the stock world than I. And then in 1990, we hooked up with Jeff Bish, who now is the partner of Market Gauge. And those two went off and created Market Gauge, which was really more of a institutional investor place for tools. So by the time I got involved with them, they already had established a bunch of tools and a bunch of strategies. So I have to say, I have to credit both of them for giving me my base education in terms of having a procedure. But since then, of course, I've run off and done my own thing. But we very much still use the Market Gauge way, for lack of a better expression, which is, we can talk about that.
Let's talk about it.
Well, as I said, I've kind of gone, when we first got started, and the same thing in the commodities market, as I mentioned, you didn't really follow the macro or the fundamentals. You knew kind of things that were going on. But as I got deeper and deeper into stocks, I started looking at, the economic indicators, and I realized that we were kind of a couple of steps ahead of the economists most of the time, because economists are necessarily not market timers, or not necessarily market timers. In fact, they're not. And so I started realizing that as I was predicting where things were going to go in the economy, it was because I was watching certain areas of the market. So I was watching the indices, but I was watching the Russell 2000. I was watching the sectors, but I was really focused on transportation and retail and regional banks and biotechnology and then semiconductors. So that created the economic modern family, which I'd say is my way of sort of stating where the macro was going to go, because they were already telling me where they were going to go. I don't always know why. Like, so for example, in 2021 in November, before the SPY and the Qs broke down, I already saw that the Russell 2000 were breaking down. And I thought, ooh, why are small caps breaking down? Gee, I wonder if the Fed is getting ready to raise rates, because inflation was starting to spike too. That's the kind of thing. So it's not like I'm this great macroeconomic expert. It's interesting that I've become known like that, because now I decide, oh, gee, I better do the research to back up what I'm seeing in the charts. So I just want to mention that. Otherwise, we use phases. My book, Plant Your Money Tree, talks about using phases to time your way in. Phase changes being the most powerful. You can look at weekly or daily charts on that. We use a 50 and a 200 simple moving average, whether it's a daily or a weekly. And then we start going more and more and more micro, right? So after that, we've got 30-minute charts where we look at pivots. And then we have opening ranges that we use based on whether it's a 2-minute, 5-minute, or 30-minute opening range. And through all of that, what we are most keen on is risk. Mismanagement is probably one of the greatest assets of market gauge that I take every day into my life and try to teach people to do.
Are you playing both long and short strategies typically?
Yes, well, with this advent of ETFs that take advantage of inverse relationships, because we have a lot of customers, my clients in my service, and also our RIA members often can't go short. They can't go naked short. And so options is something we don't do primarily. We have an options product, but for me primarily, so what I do is I use the inverse ETFs for that, because most things will. And sometimes it creates a barrier for the service, but I can do whatever I want for my own trading. So yes, going short is fun.
So I'm hearing there's a usage of moving averages on higher time frames, going into lower time frames with some pivots and some other pieces. Are you actively trading on a daily basis?
Not as much anymore, although day trading has definitely been fantastic since we've been in this bear market. But I spend so much time doing other things now. I've evolved. I guess we can say it's evolved. Some people might say it's the opposite of evolving, devolving. But I spend a lot of time on the media. And then when I'm not on the actual classic media, I'm talking to people like you in the Twitter spaces or other podcasts. So that has taken up a lot of my time doing research. I write for a London magazine. I do a daily blog. I work with stock charts. I mean, it goes on and on and on. I seem to have a problem saying no because I like to give information. So that has actually taken away from my own personal day-to-day day trading. For my service, though, we can be very, very active, but we'll look at it more for mini swing to swing trades as opposed to in and out the same day.
Okay, understood. We could talk more generally about the state of the market and the economy right now. We know we're in a bear market. We know we're in a downtrend. Overall, maybe projecting even next kind of like 6 months, 12 months, what's your feel for the economy? Maybe how the Fed will interact with it, and some of how that translates to the stock market.
Well, I'm probably more in the camp of the fact that inflation, although definitely has peaked in many areas, that people don't understand that inflation can look different in that it's not necessarily going to be a shortage of raw materials based on a supply chain issue and people not going to work like we saw in COVID. This type of inflation that I believe we're about to experience is going to be more of mistakes made by the government and by the central banks that we're already seeing take form. And what that does in that type of inflation is it creates almost a panic state of people where they want to buy hard assets. So it's different type of inflation. And I have to say, there are a few people out there talking about that, but I get a lot of arguments, and that's one of the things I love about Twitter is I get to hear other opinions about the fact that we're going into a deflation and I must be out of my mind. But I do have the advantage of experience. And I also have the ability to look at all these different factors and assimilate what I'm seeing very quickly. And I've been talking about the dollar declining since basically for the last few weeks, since it went up to 114 and change and has come down, as part of the sign that perhaps the Fed is going to lose a little control. And some of these emerging markets like Japan that's doing QE, and the Bank of England, which now we'll see what's interesting with the new prime minister, what he does. He's an old Goldman Sachs guy, by the way. Mm-hmm. So I would say he's going to err more towards the side of QE as well. And now China, after its big collapse, she is trying to support their currency. It's going to be interesting to see whether or not the Federal Reserve does the same thing, which also will not only speak badly to the Federal Reserve's commitment to what they said they were going to do, but it will spur this type of inflation, this second round that I'm anticipating, which will not be good for equities. Some equities, but not all equities, right?
Definitely not all, and definitely not in the long term.
Right.
So I agree with you on both those points. To the market right now, for some of your clients, are you still utilizing classic DCA strategies across the board, or are you kind of slowing down on that and leaning more into specific swings?
Well, we have a lot of cash right now, which is strategic because I knew this bear market rally was coming because the three key areas of my economic modern family held that long-term 80-month moving average, which measures a 6 to 7 year business cycle, which means that I kind of knew ahead of time that the Fed was going to really try for a soft landing. So we raised a lot of cash. Now we're at a very critical point here where we just rallied into major resistance. Today, as a matter of fact, as you and I are speaking on Tuesday, with the rates, the yields, I should say, dropping and the TLTs rallying. So I am looking to do more swing trades at this point when I have more evidence of either A, the Fed will indeed lose control, or B, things aren't as bad as they seem right now. The Fed slows the rate of change in how they're raising, but they don't necessarily talk about the bond buying program rumors that came back today, or buying equities or corporate buybacks, because people all still don't believe that we're going to be in this raised rate scenario. And that's when I'll start going in and looking at different things. But this is just my discretionary account. Our RIA has quant models, and they bought 5 different positions today. In terms of the big cap stocks. So we're always doing something somewhere, whether it's crypto, we have a crypto product, which might wind up getting a signal because Bitcoin crossed the 50-day moving average today. It's really going to depend on conditions. I hope that answers your question.
Absolutely. Were any of them in the energy sector?
Yes, 3 of the 5 were in energy sector, and the other 2 were biotech.
Good calls. Added some energy today as well.
Oh, okay, good for you.
Thank you. What lessons do you wish you knew earlier in your career?
I think the biggest lesson I wish I knew was I had the opposite of FOMO. I wasn't afraid ever of missing out. I was more not confident enough to believe in myself to always trade everything that I would walk around saying. I mean, I'm in the media now, right? So it's natural for me to go on Bloomberg and say, hey, guess what? I think gold is a buy because it had a double bottom. But back then when I was on a floor trader, I used this thing called commodity perspective where I'd look at the charts of all the commodities and I'd speak to a couple of guys and I'd say, it looks to me like it's time to buy soybeans, for example. And then I wouldn't do it. And I still find that my biggest obstacle for myself is not doing what I say. And I don't even know why. I think it's just part of human nature. A lot of people count on me, but then they're doing what I say. So I'd say that's probably been my biggest thing that I want to tell people, besides the fear of missing out, which is just crazy because there's always an opportunity the next day and the next day and the next day. is, if you understand that taking a loss is part of the game and you're not afraid to take a loss because you have confidence in the fact that when you actually make money, the idea is to let your winners run and cut your losers fast. If you can live by that simple credo, then if you're doing your research and you have a strategy or you follow somebody that you admire, by all means do what you think, because that's the only way you're going to find out if you're right or not, or make money, I should say.
Yeah, absolutely. And it's definitely a relatable concept to what you just spoke to, especially for me. I'm on Twitter Spaces all the time. And this morning they were like, I mean, I took several plays and I think I had like 6 or 7 winners this morning, but there were, another 5 where I was like, oh, hey, this looks real good. And I just didn't get in. And then I look, later in the day, I'm like, oh, it's up like 80%. Right? And things are just moving. So it's really, really hard, like you said. And sometimes I think it's because you don't want to overshoot with quantity, right? And you might say, this looks good, this looks good, this looks good, but you don't want to just like kind of spread out so thin. So you go to less. And at the end of the day, I also, I think that you have to find the middle ground, because you want to follow the word and follow your thoughts, but you also want to have risk management, like you were saying, right? In moderation. And if you're someone like me who talks a lot, you might say a lot of things that you want to be doing, and you have to funnel it down a little bit.
Well, I have to tell you that I think it's a fallacy to think that you need to be in 11 positions in the course of a day. Because remember now, where I come from, commodities market, all the richest people, including Paul Tudor Jones, they trade 1 or 2 commodities. They caught the gold move. They caught the oil move. Maybe they had a few positions in some other markets that were more longer term, following a trend. But they made their millions and millions and millions of dollars trading 1 or 2 instruments, and that's it, 1 or 2 commodities. So it's really what happens is you learn is if you want to focus, narrow your focus down so you're not driving yourself insane during the course of the day, is if you buy 2 or 3 things, let's say, or even 2 things, and they start to move up, add to that position, move up your stop on your initial part. Get some more profit, take some off. Get a dip, buy some more. That is the true day trader of the commodities world. I traded 1 instrument for 6 years, and that was crude oil. And I did unbelievably well, but I spent all day trading crude oil. So I'd bid, it would go up, I'd take some profit, I'd buy some more. I would do this. I'd be in and out of that during the course of the hours that the market was open, on average of anywhere between 3 to 10 times a day. And I would carry home a position if it really closed in my favor. So I'd have something to work with in the morning. So there's a lot of money to be made when the market is trending or an instrument is trending, just trading that one particular instrument. And then just, like I said, add to the position, which is a very sophisticated thing to do, and a lot of people are afraid to do it. Well, if I bought it at 80, why would I pay 82 now? Well, that's because you probably think it's going to go to 85 or 86, so why wouldn't you?
Right.
Just keep managing, keep step laddering your stops.
For sure, for sure. Especially when you find something where you really understand that sector and the fundamentals and have a good grasp on fair value. And absolutely, like you're saying, like right now, if people just like stuck with energy all year this year, like they'd probably be doing much better than people that are like trying to find something that's hot every single day and going back and forth and looking. And also, understanding, like you were just saying as well, even though a lot of these stocks are up 40, 50% this year, they are where the money's going to. They are the sector that's getting the rotation. And, you have to look at oil and other areas, right, and have an understanding of where the pricing is. All right, really good stuff. Pivoting just a little bit, let's talk Twitter for a minute. How did you get into Twitter, onto Twitter, pick your username, pick what you were going to use Twitter for?
Well, I started in Twitter in 2009 after I went to a conference in California, and I met a bunch of other traders, all of whom I still follow today and follow me, who said, hey, Mish, if you're going to start a service, you better get on Twitter. I was already writing a blog called Mish's Market Minute, so I shortened it to Market Minute. That's how that got started. And since I have been doing this, some would say that I'm doing really well because I have like 23,500 followers. I look at it and go, I see people who don't have nearly as many as interesting or accurate things or educational things as I put out who have 200, 300, 400,000 followers, and I try not to get myself into that head, because you could weigh your own success on how many followers you have. I mean, that's right. Isn't that a big issue with a lot of people on social media, is that their
Yeah.
ego
People
becomes tied
equate the
to that.
two.
Yeah, and I'm trying not to do that, but hey, I'm a person, right?
Yeah.
But in the since actually Women of Wall Street, since I've been on the media more, and I do a lot of Real Vision stuff. I did one yesterday. Now it seems that what happens is Twitter starts to snowball on itself. Once people look and they go, oh, she's got almost 24,000. You know what? She must be worth it. Follow. So
Yeah.
it's kind of like a domino effect that it just starts to explode, or maybe like a snowball that starts to get bigger. And I have made so many friends now on Twitter. Here's a great example. I'm going to the Money Show last week. So there's a guy, Bob Lang. Maybe some of you know who he is. He's a great options trader. We've been friends forever. Here's a typical great story. So years ago, I put something out. Typical me, I said, well, if it clears this level, it's going to do this. If it breaks this level, it's going to do this. And being snarky, he wrote back at me and he said, oh, that's really clear, Mish. And I was like, well, what do you think, Shakespeare? I actually put that out on Twitter. And he said, let's be friends. I love you now. And now here we are. We've been friends for years. We're meeting in the Money Show next week, finally face to face.
Wow.
So this is what Twitter is. It's a great community. FinTwit's a great community. And I get all my news that way. I never, ever, ever, ever watch news except if I'm on it. But no, I'm serious. I don't watch any of the news channels. I get all my news from the headlines on Twitter, because I do not want to hear anybody's opinion about what they think about the news. And then I follow some really great people, traders. And then, I post my photographs up there because it's helped me become a better amateur photographer and have fun.
I love it. Yeah. I think you covered really well what Twitter should be used for. So you hit the nail on the head there. I use it, a little bit more businessy because I do run my company through Twitter, but certainly it's been a great place to network, make friends, meet people. I just met like dozens of people in person last week that I'd never met in person from Twitter, some of who I've been talking to for over a year. So it really, really can relate to that. Awesome. Mish, I'm really glad we were able to run through some of your background, your work experience, lessons, and really, what you're doing now on Twitter. I would love to hear maybe just what's the future, what's next for you, as well as any other closing comments you want to add on to here.
Well, what I'm trying to do now is really work with my economic modern family to bring it to a financial literacy light. Because I have characters. I have cartoon characters, I have dolls, and Stock Charts, which I am a big contributor to, has a very serious TV studio in Redmond, Washington. And we're gonna collaborate with their producers and their content writers and their graphic people to create the series of videos along with PDFs on the economic modern family. And what I'm really hoping for at this stage of my career, it's really all about legacy. And so what I really want, there's always money to be made, and there's always different models to be made. And I'm working with a fintech company now, and I love being sort of a mentor and a guru. That's gratifying. But ultimately what I want, since I was a special ed teacher, is to leave the legacy where it can be modified to children to get whatever grasp they can get of the economy through these dolls, all the way on up to the most sophisticated wealth managers who need a visual, because we all need visual stories, right? So I think that would be my last, well, maybe not my last, because I don't want to say that. I'm still sort of young. But I would say that, and I love this business, and I'm very passionate about it, and I love helping people. But I think that would be really, for me, the most gratifying thing is if when I depart from this world one day, I have left something solid that people can sink their teeth into, that maybe hopefully make their lives better. Just like that girl who brought me down to the floor so many years ago made my life better by introducing me to the world of finance.
Absolutely. Just one encounter can take everything to the next level. Super excited for what you're doing, for what you're building. If anybody wants to hear more of Mish, you can catch her usually at 10 a.m. EST on our Twitter Spaces. You can also see her on TV, regular basis, Bloomberg, CNBC, and elsewhere. It's been a pleasure having you on, Mish. I'm really glad we got to do this. Thank you so much for agreeing to it.
Thank you so much. It was really fun to talk to you, and I look forward to many, many more times together, either through our Women of Wall Street or whatever other way we connect.
Me too. To the listeners, if you enjoyed it, you can drop us DMs on Twitter at Market Minute for Mish. I'm at Wolf_financial. You could even throw us in a group chat and tell us that you like it together. I'll be sure to respond. Thank you for being a loyal listener. Till next time, that's it for the Wolf Podcast.